Hi, welcome to our Crypto After Dark. Just having some technical difficulties, as you can see here in the back, just running a little bit late. Apologies for that. Even the intro cut out there, my bad. The crypto market is crashing. My computer is crashing apparently today. They're just out there to get me today. But look, we've got a lot happening today. We've got Bitcoin literally collapsing. We've got Bitcoin back into the 60,000s. And there's a whole lot of action going on. So let's talk about it. How are we making money? What are we doing about this? And what are the opportunities that are emerging from this entire sell-off that we're seeing? A mass amount of liquidations. I think we're getting close. I think the bottom is close. We've got Bitcoin trading next to its realized price. So we've got a whole bunch of confluence around the 60,000, 50,000 zone. Let's talk about that. We've also got the digital asset co-founder, the co-founder of the Cantor network on the show today. So, I had a chat with him yesterday. So there was a pre-recorded interview because it is 9 o'clock in Eastern time. Everybody's away from the office. It'll be quite difficult to get people onto the show at 9 o'clock. So that's why we pre-record these interviews. But let's dive into it. What is happening out here? We've got, just want to say, strictly, this is strictly for information purposes alone. It's not financial advice. So for the full terms, you can go to allstarcharts.com/terms. But look, this is it. This is it. Bitcoin back at its prior cycle highs. This is the level that I've been watching. I bought some Bitcoin today. I think that this is a really attractive setup. I don't think that the short-term damage is over. We could still see some more weakness in the short term. Even today, as I'm talking about this, I bought some, went down to 60,000. This thing could still absolutely move lower in the short term. But I think if you're a longer-term investor who just wants access to the crypto markets, you want exposure, this is the best level or the best sort of area for you to get involved. We're retesting these prior cycle highs. There's a whole bunch of panic on the timeline. Everybody is really fearful. The people that I've read in this space for years and years are leaving. They are leaving crypto. They are going to other markets. They're trading stocks, and they've just gotten out of the market. I mean, talk about Multicoin, right? Kyle Samani, one of the OGs in the space. He's been around. He was early in Solana. He literally got out of the space. He left Multicoin in his official capacity and his role that he was in. And he basically just said, hey, look, I don't really believe in the Web3 vision anymore. I don't believe in it. You got a whole bunch of people that are just leaving the crypto market. And, every time I go back home and I talk to my family and I'm like, what's up, guys? How's work going? And they just ask me, where should I be buying Bitcoin? How should I be buying Bitcoin? I want to get involved in crypto. That's my signal. I've got my brother who's my contrarian indicator. Hopefully he doesn't see this, but he's my contrarian indicator. Every time he tells me he wants to get involved in the market, he's literally, I was talking to him 3 months ago, actually, before this whole October the 10th crash and before this whole thing got going. He was like, I'm going to join this really shady group and they have like these signals. And I'm like, mate, that is a pump and dump. Like, that is literally illegal. Do not do that. And so, I walked him off the edge there. But, when I get these calls from my family and my friends, that is me. That is my signal to get out of the market. And so when the opposite is happening and these long-standing crypto investors who have been in the space for 10 years are leaving to go to stocks, to go trade commodities, to go trade any other market, that's a signal that shouldn't be ignored, particularly when you have Bitcoin at these former price cycle highs. I mean, am I crazy? At what level is capitulation? I've got a chart on that. Let me find it. I think it's right at the end here. This is it. If you want to know what the capitulation is, this is the chart to show that. This is the Bitcoin realized price. You can almost think about this as like the anchored VWAP off the inception, right? This orange line, the smooth orange line. So you got Bitcoin here, all these pretty little colors. You got this orange line. That's the realized price. That is the average cost basis of every single Bitcoin that is out there. The average Bitcoin in the market that exists in the world has a cost basis of around $50,000. It's a little bit more than 50,000. I think it's at about 53, 54. Every time Bitcoin dips below that realized price, that is a sign that these long-term investors, that these investors in crypto, they're now at a loss. And, it's the classic adage, right? The classic adage that you want to be buying when blood is on the streets. This is your chart to quantify when that blood is on the streets, when people are hurting, when people are losing money, people are in pain. That is what this chart represents. If Bitcoin gets below this realized price, which it probably will, that's your signal. That's your signal. Below 55. And look, you're just getting all these liquidations coming in. Like, how do people have this money, right? How do people have this money where they're just still gambling in the futures market and they just still have all of this money to lose? It's crazy to me that we're still seeing today, in the last 24 hours, $2.3 billion of liquidations in the last 24 hours. How do people still have this money to be gambling with? Is crazy to me. And then Solana breaking down, how gross is this? Literally a textbook topping pattern. I was buying Solana right around this support level. I'm like, you know what? Fuck it. I'm just going to define my risk below 110. And it was working out for a few weeks. And then it got to 110. And I just said, okay, I'm out. I'm selling all my Solana. Thank God I did. This thing has been an absolute disaster. And so I don't hold any Solana at the moment. Zero. And I don't plan on buying any Solana for a long, long time. But there's two positions that are really just keeping my portfolio quite good at the moment. And this whole carnage that's going on, they've kept me all right. Who is lending out all the leverage used? That's the exchanges. And so you can just go on, you can go and buy futures contracts on Bitcoin, Ethereum, Solana, all these cryptocurrencies on leverage. You obviously need collateral when your position is at a position where your collateral can't really sustain your position. They just take your collateral, they liquidate the position, and they just get what you've put up for the trade. And so it's the exchanges, it's just futures contracts. It's almost like just a margin call. Another word is a margin call. But these crypto traders, they like to use all this lingo. They like the word liquidation, not margin call. And then you look at the crypto market cap. This is excluding the top 10. This is like the mid caps and small caps of crypto. And this is what it looks like. If you look at small caps and micro caps in the stock market and you see that massive base in the Russell 2000, this is like this flipped on its head. It is, if you inverted this chart, you get like the Russell 2000. You get the Russell 2000 that are breaking out. But now in crypto, you've got all of these cryptocurrencies breaking down. I think this trend, it probably continues for 90% of the market. I think even if Bitcoin bottoms today, I think 90% of the market still bleeds lower. And it continues to bleed lower forever. 90% of the market today, if Bitcoin bottoms and gets to all-time highs by, what is it? It's the summer. By the summer, I mix around my seasons. It's summer here right now. It's not winter. But if Bitcoin gets to all-time highs by the summer, I think 90% of the market is still going to look like this and it's still bleeding lower. But there's an opportunity because everybody's focused on that 90%. They're like, I'm going to buy these cheap altcoins and these cheap crypto assets, but they're just absolute junk. So there's an opportunity to take advantage of that and actually own the 10%, or in my case, own the 1% that is actually well-positioned. The counterparties must be taking a bath at the moment. A lot of liquidations out there, Ryan. A lot of liquidations. That's for sure. All right. I mean, crypto's crashing. I'm buying some Bitcoin here. I learned very early on, if you're going to panic, you should panic early. And this is certainly not early. I think these moves in software that we're seeing in Microsoft, and obviously Bitcoin and Ethereum, they're way overdone. They're getting overdone, right? There's no There's no uncertainty about that. And so if you're going to panic early, if you're going to panic, at least be the guy that's panicking early. Because right now, if you're the guy putting on new short positions and just selling your Bitcoin exposure now, you need to get your head checked, because this thing is well overdone. I think this whole MicroStrategy thing as well. Everybody's talking about MicroStrategy. Everybody's listening to the earnings call today, which I haven't listened to today yet. And they're just panicking about this thing, and everybody's jumped on the bash Michael Saylor train. But this thing has been getting beaten up for a long, long time. And so, again, I think this thing is also overdone. MicroStrategy is now trading at a discount to what it's actually worth. And what drawdown is MicroStrategy in right now? I don't even know what drawdown it's in. But let me tell you, these trends are starting to get overdone. I'm buying some more Bitcoin. That's my spiel. I want to show the interview, the conversation that I had with the co-founder of Digital Asset. So we got on the phone yesterday, had an interview. I had to get him on to the show. I had to interview him for the show, just because even though we've seen all of this volatility in crypto, and it's just doom and gloom everywhere, crypto's over, and everybody's just crying, we need to have some optimism here, because these sell downs, these drawdowns, these sell-offs that we see, they create massive opportunity. And so the question that everybody is probably thinking right now, everybody watching, or at least I hope that you're thinking about right now, if you're watching me, is you're looking at this correction and you're saying, okay, this is all well and good, but how do I actually make money off this? What is the opportunity that is emerging here? And I think that the entire tokenization theme has a whole bunch of energy in behind it. A lot of big names are driving this trend, driving this theme. And so if you don't have your portfolio positioned in a way where you are making money off this tokenization theme, if you don't even know what tokenization is, then I think you're doing your portfolio, your family, you're doing it a disservice. You need to learn about tokenization. So that's why I had him on the show. So I'm going to roll the interview, and I'll let Eric take the show. Hey Eric, I really appreciate you joining us here for Crypto After Dark. I just want to jump straight into it. And so for readers who may not know who you are, can you explain what your role is at Digital Asset and what problem you guys are currently working on right now?
Yeah, thanks for having me, Louis. So my name is Eric Saraniecki. I'm one of the co-founders at Digital Asset. I've been doing this for a little over a decade. I am largely responsible for our network go-to-market motion, so how Digital Asset helps with the general business development of the broader Canton network ecosystem. And what we're really focused on is being able to solve meaningful real-world capital markets problems using blockchain in all sorts of really clever and creative ways, thanks to the differentiated features of the Canton network.
Cool. Well, I mean, we've heard a lot about this institutional adoption in crypto, but traditional investors, regular investors who aren't in the know, we really see the tangible developments that are actually happening right now. So do you mind walking us through what some of those recent developments are?
Yeah, I mean, I would say first give like a framework for thinking about stuff. So the way we think about the value of a blockchain in capital markets is the ability to provide what's called composability across applications. So guarantee that two completely independent applications can do something at the exact same time where nothing happens. Like think of the classical hostage standoff, right? You give me the hostage, I'll give you the money. Well, who goes first? Sort of a problem, right? And believe it or not, that's quite pervasive across our capital markets in every sorts of way. Like the settlement problem is a coordinated dance. It's not guaranteed to happen at the exact same time. And so blockchains allow us to take two completely independent assets or apps or N of those things and put them together into one guaranteed to happen at the exact same time swap. And that's just one of many sort of uses of composability, but that to us is really the big core prize and the types of problems that we can resolve. You think about international money movement, there are many daisy-chained bank accounts together. You send it to your bank sends it to one correspondent, that correspondent sends it to another correspondent, to the bank, to the user. Well, every time there's one of those hops, there's one of these, swap moments, and all those things have to get synchronized. And today, doing that in the real world means ultimately reconciliation, which just injects a ton of latency into that action. So if we have composability, I could do all those hops in one update. Everything happens or nothing happens. We guarantee that that happens. And that's the sort of opportunity that we see this technology providing to core capital markets. And then, of course, if someone can send money internationally, a click of a button with certainty, then that obviously passes through the value to the user. Significantly cheaper transfers. They save a lot of money on that process to being able to do that type of stuff 24/7. And we see this already happening at scale in a number of different dimensions in these ecosystems generically. Stablecoins are moving a significant amount of money, and they are moving them globally 24/7 in lots and lots of different ecosystems. We're particularly interested in not just stablecoins, but other forms of cash on ledger, demand deposits, cash equivalents like money market funds and treasuries. And then in particular, the interplay between those things. So I have cash, but I want yield. So can I go in and out of those things 24/7 in any size? Being able to create those types of experiences are really valuable. Or if you're a capital markets institution, being able to do repo, intraday, off hours, weekends, all sorts of different types of expansion of the markets that we are already familiar with, and with greater precision and better unit economics. And in Canton in particular, a lot of this is based around the DTCC bringing treasuries and other assets that they hold at the CSD into Canton, and the deployment of those assets into all sorts of really interesting use cases across our broader ecosystem.
It's that's fascinating. And when I talk to people about this, they always just say, Louis, how is today any different to what was happening 2 years ago or 5 years ago? I feel like crypto has always just been talking about institutional adoption, but is it actually happening? Can you give some perspective into that? I mean, what are there any numbers to really outline why this time is different and the uptake that we're seeing today compared to, say, previous cycles?
Well, look, I'll talk my book a little bit. It has been happening consistently, but in one place, and that's the Canton ecosystem. It's just coming a lot more to light for a lot of people. There are a number of use cases that have been in production for years, very quietly marching up into the multi-trillion dollars of volume per month that we see in things like Broadridge's repo platform, DLR. And so we've had steady, continuous institutional adoption in Canton, thanks to the very responsible technology approaches that we've taken, most notably the ability to deliver privacy to participants in the network. That the institutions are coming mantra has been said a lot in the other ecosystems, but we haven't really seen it happen. And again, a lot of that has to do with just not being fit for purpose. So while there are a number of really interesting experiments that have taken place on other chains around money market funds or wrapped treasuries or the beginning of wrapped equity tokens, those things hit a natural ceiling when it comes time for the institutions to adopt it, because it just doesn't give them the properties and the value and the added utility that they need to justify the expense to take on a new ecosystem.
And so, I mean, multi-trillion dollars with you said the Broadridge system there. That is, when I talk to people about that, they are just amazed that they don't really know that these things are happening. And so one thing that I was really surprised about is that digital asset has been around for a long time, and it's been around for a similar amount of time as Ethereum, right? And
Yep.
so in that respect, Canton's design has been very long and it's been very intentional. And so what problems does Canton excel at that other networks, say like Ethereum and Solana, may struggle with?
I think it's first and foremost an empathy for the institutional user. I think it all starts there. Our core thesis is that even things that were as radically transformative to humanity as like the internet, it didn't produce a whole new set of winners. There were new winners, without a doubt. There were disruptions, without a doubt. But also there were significant incumbent winners as well. And not every incumbent has a new business model. I kind of jokingly say that JP Morgan hasn't really joined the internet yet. They just opened an internet branch. The product that they provide is not really a web-enabled product per se. It just kind of is the existing product online, which is great. It's a fantastic experience. I'm not taking anything away from it. But So it's just wrong, I think, to say that a disruptive technology will transform everything by necessity. Sometimes new entrant it's really more about leveling the playing field and giving an opportunity to new entrants and facilitating an improvement in the experience for the user. So if you start there and you say, okay, we're not going to disintermediate and decentralize everything necessarily, then we say, okay, well, if we know that the JP Morgans of the world are going to adopt these technologies, provided that they demonstrate utility and that they can solve problems for their users, what are their hard requirements? And we just did a design, over that decade, working hand in hand with those types of entities to make sure that our protocol design actually allowed them to do what they needed to do. And specifically, there are things around, if you run a bank or you're an asset issuer, you need to be able to guarantee that you control those assets. I mean, forget just psychologically wanting to make sure that you control them, but in many cases, legally, the perfection of that asset is predicated upon your unilateral control of that asset. And so when you look at the design of another network and you say, okay, well, by default, I must outsource control of my asset to a pseudonymous pool of validators, that produces an immediate friction and problem right there. So just giving them the ability to configure exactly who controls what and under what conditions is a really important starting point. The second is very similar, but maybe a little bit easier to understand, which is just around data permissioning. So, if you think that stablecoins are going to be used for corporate treasury management on a public blockchain, I think you're a little bit crazy because I'm not aware of any Fortune 1000 company in the world that wants to make their balance sheet behaviors public record. They don't want everyone to know how much cash they have. They don't want to see all their international transfer pricing. They don't want to see how they're funding local branches. They don't want people to see what their bank relationships are for good reason. Or if you're a cloud provider, you're going through painstaking efforts to bury the revenue of your cloud inside the rest of your business. And if you let people start paying for compute with a stable coin in real time, I can kind of figure out what the revenues of this part of the business are. So that data permissioning, who can see what and under what conditions, is a critical capability to have in there as well, a threshold issue. So control, data permissioning, but like I led with, composability is the prize. So to be able to do both those things, but still be interoperable with everything else in the world. You want two websites on the web to be independent, configured however they want, controlled however they want, governed by themselves, but that a common user of both could put the two together and call both APIs and guarantee that it happens at the same time. That's kind of our guiding principle. So those hard requirements are the baseline, but always solved within the context of making sure that we never sacrifice global composability, because that is ultimately the whole reason to be on chain in the first place. So I think that triangle is a very difficult thing to get right and a very difficult thing to balance, but it's always been the guiding design principles that we have on the Canton network.
Yeah, it's one of the ways that I tend to explain to people just on an everyday basis is that if you're going to go buy a loaf of bread at the grocery store, and if your bank accounts are on some sort of public ledger, would you want to be advertising to the world that you've got this amount of money in your checking account and you paid $5 for a loaf of bread? People don't want that. There needs to be some form of privacy. And I think that's one thing that is one of the big advantages of Canton, and people haven't really wrapped their head around yet.
Wrench attacks are unfortunately becoming increasingly real and increasing around the world, whether that's you're holding Bitcoin or you're holding stable coins. It's the dual combination of the transparency with the sort of bearer instrument nature of these things. If I can hit you hard enough, it's mine, and there's really no entity to appeal to get it back, right? So that all starts with, well, just don't let people know that you have it in the first place, right? Protect that information in the first place. And even if the wrench attack thing wasn't scary enough for you, in like maybe a more mundane setting, if I go to the doctor and I pay for the doctor with my digital money, I don't want the doctor to find out how much money I have. That's just uncomfortable. But I definitely don't want the bank to know why I went to the doctor, right? I think that that's maybe a little bit more straightforward. So the privacy is not just of the asset, it's also in composition when I use it in different functions. I need to preserve that privacy through that. And again, if I do that by transferring you this and then satisfying that separately, and I just try to coordinate it, I'm just recreating the same problem that we're already dealing with today. So there are some really strict technical requirements and business requirements to make sure that you're solving a real problem, but not doing so in a deeply irresponsible way.
Mm. I think one of the things that really caught my attention when looking at Canton for the first time was how the actual cryptocurrency was set up. Because we can talk about the technology and its use cases and its benefits over perhaps alternatives. But in the case of Canton, there's no VC allocations, and applications that build on the network are actually rewarded. And then there's also a model. There's a burn and mint model to keep the price in line with the fundamental value of the technology. And so, can you just walk us through how that token is actually set up, and then what principles guided that design?
Yeah, I think that here we're very lucky to be a second mover of sorts in the tokenomics design. There's really a tremendous amount of prior art that you can look at, and I'm lucky enough to have been involved in these tokenomics ecosystems as early as 2010. I started poking around, Bitcoin in certain
Wow.
ways. So I've gotten the opportunity to observe and see long term what some of the outcomes of these token designs are. From our perspective, the root sort of mistake on a lot of them is that they distribute 100% of the rewards to the infrastructure provider. For Bitcoin, that actually makes a lot of sense because the power of Bitcoin is the power of its decentralization, and it has a single purpose, to move left or right or hold it, right? So it's like, from that regard, it makes sense. But when you start to look at a smart contract ecosystem, the value of that ecosystem is the quality of the applications in it, the value of the assets, the value of the DeFi, the things that are connected, the wallets. That's what actually builds the value of that ecosystem. So giving 100% of the rewards to someone, I'm going to be a little bit reductive, who's just running a server. They're not building a business, they're not marketing, they're not acquiring users, they're not iterating aggressively over how to improve the user design and user acquisition. That is such a low risk, low value effort. And in fact, millions of people do this in Ethereum. For 100% of the rewards to go to that element of the network is overweight. And ultimately, you should have instead distributed the bulk of those revenues or emissions to those that are building the quality of the ecosystem. And again, just like we use the internet as our guide for the conceptual principles for the protocol, actually, credit card networks are pretty good in thinking about this too. Like the rails, the infrastructure, it does get compensated, but a lot of the revenues go to the acquirers and the merchant, and like all the people that are actually making this thing go are the ones that are actually going to participate in the bulk of the economics of that system. And so we thought more along the lines of an interchange is kind of like the root inspiration for a lot of this. And so if you are a user infrastructure or application in the network, you are going to receive the overwhelming majority of the rewards in the network as measured by how much activity you actually drive into the ecosystem. It's not a perfect system. We learn a lot about it every day. Collectively, the community adjusts as we go. We're learning. But I think from a philosophical perspective, it's a lot better incentive alignment for me than just effectively taxing everybody directly to the infrastructure.
Mm. I mean, this is fascinating. I could genuinely be talking about this for hours, but I know that you're a very busy man. There's a lot happening there at Digital Asset at the beginning of the year. Where can people go to find out more about the work that you guys do?
I think the best place to go would be Canton.network. That has a really strong overview of the ecosystem that's run by the foundation. A lot of information there about what's going on in the broader network.
Okay, that sounds good. Well, look, Eric, I really appreciate your time, and thanks for joining the show. How good was that? How good was that? I'll put the chat up. Feel free to drop any questions. But look, I think looking out and all of this volatility, it's really important just to zoom out and say, hey, there's some opportunity forming. Where is that opportunity forming? Because the reason, or a big driver that is driving this absurd weakness in crypto, is investors and the market have cottoned on to the fact that a lot of these tokens, a lot of these cryptocurrencies, they don't even really have a real reason to exist. Why do we need hundreds of different cryptocurrencies? Why do we need 50 different blockchain networks that all pretty much do the same thing? Why do we need that? And the answer is that we don't. We probably need a handful of networks that have got different purposes. We need new applications that just takes all the complexity that we have and just simplifies it for the everyday person. And so I'm looking out, and I think this weakness is creating a whole bunch of opportunity. And so I want to be focusing on names like, I talked about Hyperliquid last week. We're talking about Canton today. You have a look at some of the price action, and these are the names that are holding up the best. And it's no surprise that in this entire crypto crash, the very select few names that are holding up the best are the quality assets, are the assets with real revenues, real people are using them, and these cryptocurrencies are set up in a way to benefit their investors. You have a look at all of these cryptocurrencies that are on their way to zero, and they're basically set up in a way where the company owns the IP, the company has developed the technology, owns the intellectual property, and then they just have a random cryptocurrency on the side that just votes on things. That'll be the equivalent of owning Apple shares, right? Of owning Apple stock, but you don't have any claim on the assets. But all you do is you just turn up to the shareholder meetings and you just get to vote on the direction of the company. They would have some value, but the value would be pretty significantly less than current Apple shares, right? Because you don't really have any claim on the asset. And that's the problem with a lot of these cryptocurrencies. They have no real reason to exist, and nobody is using them. And even if people did use them, they would have no way to capture that value and then make their investors rich. And so the tokens and the cryptocurrencies and the technologies that are fixing that, surprise, surprise, are holding up the best in this entire correction. Let's talk about some of them. We're talking about this, like the small and mid caps of crypto and the micro caps, breaking down, absolutely terrible. You look at Cantor Network, which we just had the co-founder of Digital Asset, the company responsible for developing the Cantor Network. And you have a look at crypto that is absolutely crashing to new lows, but yet this is breaking out to all-time highs and nobody is talking about it. Even in my circles, I talk to a lot of crypto people. I say, hey, what do you think about Canton? They're like, huh? What's Canton? I've never heard of that before. If that isn't bullish, my God. Hyperliquid, we talked about Hyperliquid last week. Again, just look at the relative strength here. Crypto is crashing, and then this one is holding up just fine. Bitcoin is way below these lows. Hyperliquid is up 50% from these lows. And do you know why that is? Because they have a business and an exchange that actually generates $1 billion of revenue every year, and they take 90% of that $1 billion that they generate every single year, and they immediately buy back this token. It is simple as that. Stop overcomplicating it with all of these shitty tokens that don't do anything, that have got no real reason to exist, and actually focus on the stuff that is solving real world issues like Hyperliquid, and then they have a way to make their investors wealthy. And there is such a significant opportunity here because everybody is focused on these terrible assets. You go on Twitter and people are talking about some random cryptocurrency, but in the meantime, like my portfolio is doing just fine. So I'm holding the actual real crypto assets that are generating real revenues, and they're working every day to make their investors wealthy. Stop overcomplicating it. I believe Tom Lee is still positive on Ethereum for the year, but maybe with lots of volatility. Is his expectation solid enough? I heard something very wise today from I won't say his name, just in case he doesn't want me to say names. But I heard something very wise today. These people like Tom Lee and Michael Saylor, they're salesmen. They're not really investors. They are salesmen. They're there to be a cheerleader for their company. Tom Lee isn't going to go out there and say, oh, well, Ethereum has just broken down to new lows and, we're going to have some more vol. No, because who would want to invest in Bitmine? He needs to be a cheerleader and say to everybody, I think that Ethereum is going to go to 4,000 by the end of the year. I think that, Ethereum is going to be the next big hottest thing because he's incentivized to do so. These people are salesmen. And if you don't recognize that, then you're an idiot because these people are incentivized to make themselves and to make their shareholders wealthy. And I've got no problem with that. They're doing what a good CEO should be doing. They're going out here trying to be a cheerleader for their company and trying to make their shareholders, including themselves, wealthy. I respect that. But if you aren't aware that these guys are salesmen, you deserve to lose your money. That got really dramatic, didn't it? Oh, it got really dramatic. I'm passionate about these things. Like Kurt said, holy shit, exclamation point, exclamation point. I mean, am I wrong? Not to pick on you, Bill. I'm not picking any fight with you. Just the sentiments is all. And again, looking at Hyperliquid, this thing is breaking out to all-time highs relative to Bitcoin. This is relative strength. What else is breaking to new all-time highs in the crypto space, at least relative to Bitcoin? Everything else is bleeding lower. Hyperliquid is leading the way. This thing has gone a literal vertical line higher. Relative strength. No problem. Thanks, Bill. Thanks for being a good sport. We have fun around here, don't we? We have fun. This is the chart. Again, if you're a long-term investor, you need to be looking at this chart because the realized price is basically the pain point. You want to be buying when everybody else is suffering and losing money because those are when the best opportunities emerge. We're nearly there. It's around 55,000. So we're trading at the low 60,000s when I went live. So we're getting close. I've started buying some Bitcoin. I'm going to be buying more if we get below here. I like that strategy a lot. All right, so we've talked about the crash, about the opportunities that are emerging. Had the co-founder of Digital Asset, which is responsible for the Cantor network, on the show. Great conversation. And then we've talked about Hyperliquid. One thing I want to close up with, let's just poke a little bit of fun, because that's what we like to do around here. We like to have a bit of fun. Let's poke a bit of fun at some of these crypto projects that are going to zero. I want to make sure that you are not holding any of these crypto projects because they are already bleeding to zero. Is everybody ready? Everybody ready to go down the list one by one of all the crypto projects that are going to zero? I mean, not all of them, of course, because we can't be here for 2 hours going through 20,000 cryptocurrencies, but just a handful. Tezos, these guys have raised, I think it's over $150 million over the years. They're trading at a fully diluted market valuation of $400 million. So raised $150 million. They are currently worth, this token is currently worth $450 million. Yet, they have $30 million locked in their ecosystem. And nobody uses this. They've generated, in the last day, $9,000. $9,000 for something that is worth supposedly close to $500 million. And you got Algorand. I remember when Algorand was the next big hottest thing in the world. And it was this new, what is it? It's this, there's a term for it, like delegated proof of stake. I think that was the term for it. I could be wrong. And it was this next big hottest thing. These guys, again, like Tezos, raised a lot of money. I think this one is trading at about a $900 million fully diluted market valuation. Yet they have less than 10% of that locked in its ecosystem. Only $67 million are actually churning around. Look at that. Chain fees. I'm going to remove myself here. How do I remove myself? Look at this. In the last 24 hours, look at these guys. They are just hard at work over here. $20. You know, I could buy myself probably 2 Big Mac combos with that. Maybe just one, like a single Big Mac combo. That's a lot of hard work has gone into this chain. $20 in the last 24 hours. And you know what? Investors are like, I see that, and I think that thing is worth close to $1 billion. You know, that's about 365 Big Macs over a year. I'm going to value that at about $1 billion. This one's going to zero. Zeta chain, this one's a little bit smaller, $7 million. And this thing has got a market cap of about 100, or fully diluted, I believe about $100 million, but only 7 million. Look at the amount of volume. So, okay. So this thing is worth $100 million, and the amount of volume moving around their exchanges on this, $8. $8.78 in the last 24 hours. $0 in revenue. Nobody uses this. But the market is like, let's just slap a $100 million price target on this. That's how much this thing is worth. It's going to zero. Are you leveraged long on this dip? Absolutely not. That is a crazy comment. Multiverse. There used to be Elron, $28 million. Again, the amount of volume that this thing is doing, like all of these things, you just go down the list one by one by one, and that's literally what I did over the last 6 months, one by one by one. Top 1,000. So many going to zero. But then again, that is just such an opportunity because you have all of these really terrible assets, and the market is probably going to throw the baby out with the bathwater. It's just going to be indiscriminate selling like you're seeing right now, and you're seeing opportunities emerge because you're seeing genuine businesses and technologies that are being drowned out in all of that noise, that are being thrown out with all the other trash. That is an opportunity. It's an opportunity that nobody is talking near enough about because everybody talks about all these zeros, and so do I. But they don't talk about the technologies that are being thrown out with the trash that are actually doing incredible things. I'm absolutely not leveraged long on this dip. Curious, what does XRP look like? Have you guys seen The Big Short? And at the end of The Big Short, they have is it at The Big Short? And it's Michael Baum, and I think he's in the crowd. And he's just like, zero. That's what I think about XRP. There is no reason for this thing to exist. And think about it this way. You know, we just had the digital asset co-founder on the show for an interview. These guys they're moving $8 trillion a month on behalf of listed financial institutions. Biggest, most esteemed financial institutions in the world. Why do we need Ripple? Ripple hasn't done anything like that. In its entire tenure, it's just been this thing it's just been this project filled with conspiracies about how it's going to get uptaken by institutions. It's never happened. So I think in the next 12 months, Canton flips Ripple. All right. I've been very, very vocal today. A lot more vocal than I normally am. You know, this volatility just has me amped. It has me juiced. So it's coming through today. That's all I have. You know, we've talked about this correction. We've talked about this crash. I'm buying some more Bitcoin. Had a great conversation. Talked about all these zeros that we're seeing. Some of these leaders. That's all that's on my mind today. I'm going to wrap it up there. It's been a lot of fun. I've enjoyed this. I hope you've enjoyed it too. I'm going to be at the same spot. This spot right here, 9 p.m. Eastern time, Thursday, next week. Appreciate you guys for joining me. Thanks.